For Wall Street Media, this is Nikki. I'm here with Doug, and we'll help you make money in the stock market with information you can't find anywhere else.
That's what we do, and we've got more exclusive stuff for you. We have Rich Gordon, super genius, brilliant guy, lots of ethics, quite a lot like one of my idols that we did yesterday, Boone Pickens, another brilliant guy. And they both came to the same conclusion, okay? It's time to get off your ass and do something now. Not committees, not write memos, not have nice little marches or anything. Get off your ass and do something about renewable energy. We have Boone Pickens. You can come back and see it at WSMCO.com. And we've got Rich Gordon right here for you. Two smart, brilliant, successful guys telling you now's the time for renewable energy.
Last week's non-farm payrolls number highlighted the inherent weakness in the economy. 62,000 jobs were lost, the sixth straight month of jobs decline. Corporations are paring back payrolls in expectations of tepid growth for the rest of 2008. The combination of declining home prices, tighter credit conditions, and higher commodity costs are making the environment difficult for the U.S. consumer. Commodities are the most immediate concern. The increases to the cost of food and energy act like a tax increase on consumers, and it deprives them of sizable portions of disposable income. The chart shows that the CRY index is up 25% so far this year. It's a significant shock to Americans already reeling from a decline in their home prices and upward adjustments on their mortgage payments. Long-term inflation expectations have increased by almost 75 basis points over the past several months. All of this has weighed heavily on stock prices, and they've broken through several key technical support levels over the past 2 weeks. It's disturbing that even though the Dow and the S&P are off 20% from their peak, stocks in the U.S. still don't look that cheap relative to stock markets in the rest of the world. The table shows the current and estimated forward PE ratios for the major stock markets worldwide. With an estimated forward PE of 11.5 for 2009, the S&P looks to be priced richer than European stock markets like the FTSE, which shows an estimated forward PE ratio of 9.4. So it's hard to make a strong case for global equity managers to sector rotate into the U.S. markets yet, particularly considering the slow economic growth expected for the rest of 2008 and maybe into 2009. With world stock markets under pressure and credit spreads widening in almost every fixed income risk sector, treasuries have gotten renewed interest from investors looking for shelter from the storm. On Monday, the 2-year yield broke through a short-term support level and dropped inside of 2.5%. The spread between the 2-year and Fed funds is narrowed by 60 basis points over the past 3 weeks. The Fed doesn't look like it's going to be able to raise rates and slow inflation, because doing it might deepen the economic slowdown. Turning to the spread markets, there isn't a risk product we track that has seen tighter spreads over the past few weeks. CMBS in particular has been weak based on reports of increases in commercial mortgage delinquencies in bank portfolios. The second half of 2007 and first half of 2008 will be remembered by fixed income portfolio managers as the most difficult period in which they've ever managed money. There's virtually no risk product that produced acceptable positive excess returns during that period. While long duration positions benefited some managers last year, this year long duration has been the incorrect bet as the Fed moved to a more neutral stance with a tightening bias. Most cross-sector portfolio managers don't have the flexibility to capitalize on the run-up in commodities prices. Instead, they're left to deal with the deleterious effects of sky-high commodities prices on their portfolios of corporate and consumer credits. Last October, I was talking to my father about the state of the markets and whether the U.S. was going to maintain the same position of hegemony going forward that it's basically enjoyed since World War II. His response was simple. He said, the last half of the 20th century was all about technology. The first half of this century will be all about energy. At this point, there aren't many people who would argue with that statement. It raises some fundamental issues along with a few additional thoughts. First, the price of oil is above $140 and gasoline prices are over $4 a gallon. People's behavior is changing as a result. They're buying fewer SUVs, using less air conditioning, taking fewer vacations, and using mass transit to commute, among other things. If anyone before wasn't sure at what level the price of energy would begin to take a bite out of economic growth and consumption, they have their answer now. Also, we're finding that at very high levels like we have now, the relationship between energy prices and consumption probably isn't a straight line function. Further increases would cause even more severe behavior modification and reduction in consumer spending. Energy costs act a lot like a regressive tax on people, so the social aspects to the increases are troubling. The cost of energy is emerging as the single most important theme in the elections in November. Second, there are some debtors that aren't able to generate enough monthly cash flow to pay all their bills, and they appear to be electing to pay their credit cards and forego their mortgage payments. This might explain why residential mortgage delinquencies continue to increase, while credit card delinquencies look like they've flattened out. The last thing I'll talk about should be self-evident. The U.S. needs to break its dependence on foreign oil or risk losing both its hegemony as well as the dollar's status as the primary reserve currency in the world. The U.S. currently gets less than 7% of the energy it consumes from renewable energy sources. A lot more of it has to come from solar and wind going forward. But the real key to reducing our dependence on foreign oil lies with nuclear generation and new technologies for transportation. The chart shows that the percentage of electricity that we get from nuclear has held constant at around 20% since the late 1980s. There's been no increase in the number of nuclear power plants operating in the U.S. over the past 20 years. It's interesting to note that the oil embargoes and skyrocketing fuel costs in the 1970s led to a sharp increase in nuclear plant construction and energy generation. Necessity is the mother of invention, and those efforts eventually helped decrease our dependence on foreign oil and kept prices fairly low thereafter. We need to do it again.
We're here every day at Wall Street Media. You can find us directly at WSMCO.com. Thanks.